so much to everyone for joining us today and for being here for our fall client event. We're excited to have you here with us and hope you enjoyed a wonderful summer and are looking forward to a fantastic fall. We are looking forward to just a great conversation with you today. Now, before we get started on everything, I do have to briefly mention that this event is for informational purposes only. It is not offering specific investments or individual investment advice or recommendations. Just had to get that out of the way. Now on to more of the more exciting parts is that today we are going to go over some important client service updates. We're going to review our financial market outlook, also go over some investment updates with you, and we'll finish off with the fan favorite, which is an open Q&A section. For that Q&A section, we encourage you along the way through this event to jot down your thoughts, your questions for us. Feel free to chime in at the end of the call or the meeting to share them with us. However, if you prefer, feel free to use the chat feature or the Q&A option where you can just provide your questions to us along the way. We'll keep them under our recording and make sure we address them at the end of this call. I will say though, if you can keep your questions more general, that would be really helpful. If you do have specific portfolio questions about your situation, we strongly encourage you to just reach out to us after the meeting, either by email or phone, and we'd be happy to individually talk with you about any very specific items that you might have. All right. Now, without further ado, we do have some exciting client updates for you. The very first, which I think is the most important, is that our team is growing. Back in July, we introduced Katie Fisher. Katie Fisher came aboard as our new operations director and your go-to expert for your client service needs. Katie is just outstanding. The more and more we get to know her, the more we realize we just totally lucked out. She is not only phenomenal as a professional, she's fantastic just as a person. Some fun little notes about Katie, though, is that she was a scuba diver instructor in the Cayman Islands. She's a certified skydiver. She's ran 100-mile trail races and done very well. She's also secretly an incredibly talented artist. So, I mean, we're just so lucky to have you aboard, Katie, truly. And we're excited for each and every one of you to get to know her over time. So if you have any questions or client service needs, or you just want to get to know Katie, feel free to reach her just at our general email, katie@pringturner.com, and also our main line. Trust me, you'll want to get to know her. She's awesome. And with that, I think it's just fair for Katie to kick this event off, and she's going to go over an important client service update for you.
Thank you so much, Pamela. I really appreciate the really wonderful introduction. I'm really excited to be part of the Pring Turner team. I look forward to getting to know each and every one of you. And as Pamela said, call, reach out. Happy to take care of your client service needs, but also if you just want to call and just chat, I'm up for that too. So I'm here to help in any way I can. And so one of the things I'm going to talk about today is just mitigating fraud and how we can help each other mitigate fraud when it comes to our financial accounts. So I'm going to go through a few bullet points and some of the highlights so that we can start using right away. So 75% of all cyber attacks start with an email. And so one of the things that we want to make sure that we're always doing is not putting sensitive information in an email. And just a reminder, do not put full account numbers when you email Pring Turner. What's wonderful is we know who you are, and you can even reference your account as an IRA or a trust, but don't put the specifics in there. A good rule of thumb is if you wouldn't put it in a postcard, don't put it in an email. And we'll always call to verify if it's a transaction that needs extra verification. The next thing I'm going to talk about is suspicious emails. We would always love for you to notify Pring Turner or Charles Schwab if you get a suspicious email from either one of us. If it's something that just doesn't look right to you or just doesn't look legitimate, call us. We can validate whether it's a good email from Charles Schwab or from us. And it's just always important you don't click on any links that you're unsure of. We'll get to the bottom of it and make sure it's legitimate. Same goes for us. If we get a email from you that just looks a little odd and suspicious, we'll call you to make sure it's valid as well. So we'll keep each other in check to make sure there's no email scams going on either direction. The next thing I want to mention, one of the things that we do to mitigate fraud, but also share important sensitive information, since we're not doing it by email, is using the Pring Turner Vault. Many of you have already used the Pring Turner Vault. It's also called the Black Diamond Vault. And if you do need to share information with us, this is our preference. If you're not set up on that and need to share a document with us, give us a call. We'll get you set up, walk you through the process. It's actually very easy, and it's also an application that you can use with your phone and or tablet. So that's definitely how we're sharing documents these days. So we'll take care of you should you need to do so. The next item I'm going to go over is using Schwab DocuSign for a secure and easy signature. We're using this as our preference in today's world because of the mail fraud that's been going on. And what's nice about using an electronic signature versus your own wet signature sending through the mail is there's more authentication and a verification process that Schwab uses. If you're already set up on Schwab Alliance, you'll use your already set up user ID and password to sign the documents. If it's a new document and you're not set up at Schwab Alliance, we can also use your email and your phone number as a text for another authentication and verification process. So it is really a nice feature. It's easy for you, and it's faster processing for documents at Schwab. So we do recommend that. The next and last thing I'm going to go over is, I mentioned it a little bit earlier, but one of the best practices that financial institutions can use is always a verbal verification for a transaction. So if you did email and it was a request for a withdrawal, we're not going to make that withdrawal just by using that email. We're going to call you, we're going to verbally verify the information. And again, it has proven to be the #1 method of mitigating fraud and transaction fraud on financial accounts. So we're always going to do that. So if you do send an email, just let you know, expect a call from us probably very shortly. So that is the 5 points that I wanted to go over. Again, just a quick synopsis of what we can do to help each other out to make sure we minimize any fraud. So I'm going to bring things back over to Pamela, but before I do, many of you already know that she became a certified financial planner this past year. And this was a really exciting thing, not only for Pamela to start a new role as a financial planner, but Pring Turner is now able to we're now able to have this as an available service to all of our clients. And it's just a really exciting thing to watch this transition happen. Pamela is already helping clients with their financial planning and doing an amazing job. And I'm going to let her talk more about this, but I'm going to sign off for now. Pamela, I'm going to pass things off to you.
Thank you so much, Katie. And yes, so it's very exciting. It's wonderful being a CFP, Certified Financial Planner, and to be able to extend our offering to you and your loved ones. And with that, I just wanted to go over some high-level updates that we have for our financial planning offering. And the first I wanted to go over is our selection of our financial planning platform. We're using a platform called Money Guide. Money Guide is one of the most reputable, trustworthy, and highly used platforms across the industry. We feel very confident with using this platform as an added service and level of service for you. And rather than me jibber-jabbering, I'm just going to play a quick video. This video is going to go over the basic tenets of Money Guide, why we like it, and also the importance of financial planning in general.
Thinking about what you will do in retirement is fun, and planning for it doesn't have to be difficult. Only 3 out of 10 Americans have a financial plan, and 1/3 report they have no retirement savings. That could be a problem. Working with a financial advisor can help. Financial planning is not just all about assets, investments, and net worth. It's about how you feel and what you want. It's about identifying your expectations, concerns, and goals. Yeah, that makes sense. It's about making sure you achieve your goals, your needs, wants, and wishes. At the end of the day, isn't that what it's all about? Financial advisors who use Money Guide Pro can create a customized quality financial plan for you that includes your expectations, concerns, fears, and goals. Learn more by talking to your financial professional.
Wanted to just let you know, we keep saying this benefit is for you and yours. So what does that actually mean? What we mean is that this is complimentary to you and your family as an added service. So for example, we had an 80-year-old client who, she was in retirement, had zero interest in financial planning. That's okay too, but her son, who was in his young 60s, was very much interested in having a financial plan. And he knew that this was an added value that we were more than happy to offer to him. And so we did. And at this point in time, we've actually not only created a plan for him, but we're also continuing with periodic reviews, ensuring he's on a successful financial journey. It's been widely, received not only by him, but by other clients that we've offered this service to. And so we just wanted you to know it is an extended complimentary service to you and truly your loved ones as well. Now, inevitably, whenever we reiterate this offering, we tend to get swarmed with very similar questions. So I'm just going to quickly go over and answer one of the key questions that we always get is, what does this offering look like? What can I expect if I wanted to have a financial plan with you? And so I'm going to go over that right now. The first step in the process is we just work with you to understand your situation. So your unique goals and wishes, your concerns, and so forth. Once we have a grounding of that, we work with you to set up your profile now on Money Guide and to input all of your data. And we help you through that process if you have any concerns or questions, but you have your own personal login to go ahead and make adjustments or updates as needed. From there, we then analyze the data and prepare quality recommendations for you. Once those are ready, we will sit down with you, whether in Zoom or in person, whatever you're comfortable with or able to do. At that point in time, we'll set up some periodic reviews to make sure that you're continuing on a safe and successful financial journey. The last puzzle piece is that financial planning is adjustable to your life circumstances and your life changes. So please feel free to reach out to us at any time when you have changes to your circumstances. We're happy to make modifications to your plan in a timely manner and also update our recommendations along the way. With that, I am excited to pass the mic on over to Joe. He's going to go over our financial market outlook and business cycle review.
Thank you, Pamela, and thank you, Katie, both of you. I'm going to ask our audience now to take off their administrative and their financial planning hats and join the uncertain, confusing world of the financial market outlooks. And with that, we always start with the economy, and it's like, what's going on? Going at what level? Are we in the economy? What sort of forces are affecting the economy? What time is it, essentially? And that's where, for many, many years, we have used the business cycle, which really, we're not so much interested in business itself. We are interested in the fact that where we are in the business cycle, the roadmap there affects the various financial assets that we invest in. So the question is, where are we today? And notice that this is business cycle number 35. And We finished business cycle number 34 back in June of 2020, and we have been moving along ever since. I don't know if you all can see the business cycle. There we go. So we anchored that left bottom part in June of 2020, and the economy has been growing.
Oh, Joe, you froze there for a second. Can you go back to starting from the bottom of the cycle sequence there and continuing?
Sure. I apologize. We have changed our internet hookup here to Elon Musk's new Starlinks, and apparently there's a little lag as the computer searches the skies and moves from one satellite to another satellite. So I beg your indulgence. You may lose me periodically for a few seconds, but I'll come back. So anyhow, the economy is part of our clock, and we started this new business cycle, number 35, back in June of 2020, and we have been the economy's been moving up, but we are also interested in the asset classes. So what we've seen is the stock market, which we obviously have a great interest in, the stock market belongs to a class out there of leading the economy. They tend to lead in terms of business cycles, and they'll be anywhere from 3 to 6 to 9 months ahead of the economy, which makes it a little confusing sometimes. And then the other asset classes are things that we're interested in are the level of inflation and interest rates, as that would affect bond prices. So as we look at that as a lagging indicator, this is the mix of what we're always trying to determine where we are. So if you go back to February, the last time we gave a webinar, we said we were approximately here in the shaded area. Well, it turns out we have a mea culpa here. We were probably a little further along than where we indicated in February. We moved the shaded area a little further to the right, and that's really closer to where we were. So now let's fast forward 7 months from there, and where are we today? Well, some of the observations we can make is the stock market, well, that's been rolling down. We've had a pretty severe correction, and we're down at least since January of this year. So we're well down the right-hand side of the stock market. The economy, the blue line, we pretty well flatlined up over the top because we've gone nowhere now for 6 months. We might have a little uptick this quarter, but not much of one. And certainly we could look at inflation, and we know that has been roaring, as have interest rates. So best take is this is about where we are. We think inflation could well be peaking in here. It's going to be sticky for a while. Interest rates might have to go a little bit further up. For one of the rare times they might separate from inflation. So anyhow, our best guess is we are about in that shaded area. What we do want to look at is putting all of this together is creates an economy that is struggling. It's hasn't gone anywhere, but we couple that with inflation. And when you put a stagnant economy together with higher inflation, we have stagflation. And that's a term that was formed back in the 70s. And we're going to revisit that right here with this particular chart, because inflation is the big problem facing us today. The big number one problem for the Federal Reserve, It's a big problem for investors, for business owners, and so on. The problem is, if you look at the far right of this chart, and you're looking at a 60-year history of consumer prices, and you can see how this has exploded up in the last number of months here. And in fact, it's the highest inflation level that we've had since the 70s. And I'd like to point your attention, if you would, to those 3 inflation spikes that we had back in the late 60s, early 70s, 1974, again in 1980, 81, 82. And that's the concern that we are faced with, is have we let inflation out, the inflation genie out of the bottle? And that's a big question that we're going to have to wrestle with in the future. Also note, if you will, in this chart, especially looking over at the left-hand side, there are shaded areas, bar shaded areas that are associated with some of those spikes in inflation. And basically, those are recessions. And it takes a recession, it takes knocking the economy down a couple of pegs to really bring inflation under control. And that's the issue that we're faced with now. So the problem is not going to go away, and we're going to have to combat what's going on and deal with the spike that has now shown up in the recent months. Now, the Fed has got a job, and their job is going to be, how do they get inflation under control? And you can call me Doubting Joe. That should be Doubting Thomas, but I have concerns that the Federal Reserve is going to be able to do this easily, let the air out of the inflation bubble, bring the economy down nice and smooth. And I'll tell you why I have some doubts, because all we have to do is look at recent Federal Reserve policy. And let's start out with 2009, which was after the Great Recession that we had, the Great Financial Crisis of 07, 08, 09. And the Federal Reserve had an unstated but informal 2% target for inflation. And they formalized that in 2012 when they actually came out with one of their printed annual outlooks. And they said, you know what, we are targeting 2% as a way to serve our mandate of stable prices. Now, that sounds like government speak to me, but stable prices of 2% inflation. You can fast forward then on to August of 2020, and now we have gotten through the pandemic, and inflation in all those 8 years never really reached the 2% target. And so the Federal Reserve, in their wisdom, said, well, don't be concerned if we average more than 2%, because we're going to take an average of all the years that we're under 2. Maybe we go over 2 for a little bit. And they stood with that until the first quarter of 2021, when inflation started peaking above 2% for the first time. In the winter, spring months, we hit 2, 2.5, 3, 3.5, 4. And now the Federal Reserve says, not to worry, everybody. This is all transitory. Don't worry about the fact that we snuck above 2%. It's going to go away. Until August of 2021, when November of 2021, when Chairman Powell, in response to watching inflation go up month after month after month, higher and higher, and he finally had to admit, this is a good time to retire that word transitory. And that brings us up to just a few weeks ago that we had Chairman Powell at a meeting in Portugal with other central bankers from Europe making this admission. This is the scary part to me. I think we now understand how little we understand about inflation. Well, folks, the Federal Reserve was created in 1913. They've had over 100 years employees. They spend tens of millions of dollars. I know they have something in excess of 300 PhD economists that are all doing this research and all trying to figure out how to pull the levers on this whole thing. So you have to paint me a little bit of a having some doubt that they are going to be able to bring things down. Now, this is the important part that happened just 2 weeks ago. Chairman Powell now said, and this is what we're faced with as money managers, as trying to figure out what's going on and what's involved in the future outlook. This is what Powell said. We are committed to and will succeed in getting inflation down to 2%. The process, people, is likely to involve some pain. So that's essentially what we have to face with. And you know, the Fed has got a pathway now from 9%, creating some sort of pain, we don't know what that is, from 9% down to 2%. And I think that what none of us know, what are going to be the consequences. I think some things could break along the way. You know, there's going to be consequences, unintended consequences of bringing an economy, putting the brakes on it to bring inflation down. I think of things a little bit like the Federal Reserve is pushing us into a pinball game here, where we're going to see the economy, which is the ball that's going to be flipped from one side of the game to the other. We're going to hit inflation on one side, and then we're going to get flipped over and hit the other side, which is recession, and then too much pain there. The Federal Reserve will pivot and put more money into the system, and will generate another level of inflation. So this is the outlook I think that we have to be on the lookout for. And if I were to wrap everything up in terms of the message here, this would be the takeaways from our observation of where we are in the business cycle. There's no doubt inflation is problem number one. We're faced with it even today with a stagnant economy, or economic stagflation, if you will. I think we're faced with a pinball economy that will be very similar to what we saw in the 70s. That's the hazard or the risk out there. That's going to require a lot more diligence and a lot more discipline to managing risk, which without inflation to bother markets or to influence markets for the last 30 years, really, we're going to have to take a much more active role in managing risk in portfolios. And that takes us to really being all season investors, which is basically, you know, there's a time to plant, there's a time to invest, there's a time to cultivate portfolios, there's a time to harvest, and a time to sit back and just be patient and you know, look for our opportunities, be very selective out there. And in fact, All Season Investors is the title of the book that our partner Martin Pring wrote back in 1992. So we do have some experience in getting through this type of world, and I think Martin can carry us on now to his message of how we navigate what we're looking at to be an all-season investor. So with that, I'll turn it over to Martin.
Thanks, Joe. Sorry about that delay there. I'm going to be talking mostly about the relationship between the economy and the stock market. You've heard a lot of talk about recessions and so forth recently. Well, we'll get into that as we get through the presentation. So here's a chart of the S&P composite between 1955 and this year. And you'll notice that I put some little ellipses up there. Those are showing market reactions to events that have taken place in the economy. The blue ones highlight economic slowdowns. That's when the growth path of the economy comes down and slows, but doesn't go into a negative state. And the pink ones represent mild recessions. But I didn't cover in a lot of the more serious bear markets, which are associated with more serious recessions. And what you can see is that, or I should say, what we do is we kind of discern between the smaller bear markets and the bigger bear markets. The smaller bear markets we call burglars because they chop up about 10 to 20% of the value of the stock market. And it's usually relatively short, a few months, maybe even less. And you get back to the old highs pretty quickly. Well, the other ones we call the bank robbers because they are associated with much weaker, much stronger recessions that last a much longer period of time. And they also involve losses not of 10 to 20%, but more like 40 to 60%. So what you can see is that I've drawn in some arrows here, which kind of indicate that the burglars are all associated with a rising trend here. They're kind of like a pit stop on the way further up. You gather some, at a pit stop in a car race, you stop to get some more gas, you take a step backwards, you rotate tires or get new tires or whatever you do, and then you move on to the end of the race. Well, the same thing is true of these burglars. They're kind of like pit stops on the way of this big, long uptrend, which we call a secular or very long-term uptrend. But when you come to the burglars, you can see that the market essentially in nominal terms moves sideways. But that's not the way it works in the real world, because we've had 8% inflation. And when we've had lots of inflation in the past, that's been very devastating for markets. So I'm going to put up the next chart, which is going to be the S&P composite, which is going to be deflated by the CPI. We get a different picture here. We still get our burglars and we get our bank robbers, which are a little bit bigger because because most of these major bear markets take place during a period of very massive inflation. So we still got the burglars, we got the bank robbers, and we still got the long-term uptrends where the burglars appear. But what's different about this when you adjust it for inflation is you really get to see how devastating bear markets can be when you have a lot of inflation. So instead of going sideways, the secular bear market takes you in a downward direction each successive cycle. So the question is, we've come down about 20% already. The question is this a burglar? And if it is, it represents a great buying opportunity. Or alternatively, is it a bank robber, in which case we could expect to see more on the downside? Well, one thing I can observe a couple of things here. One is that in the previous secular bull markets, we've had quite a few of these burglars. In fact, in this cycle here, there's one in 1951. So there were 5 in that up move there in that secular bull market. And there were 4 in the 1982 2000 bull market. And we've already had 4. So we're getting pretty long in the tooth here. It's not to say we can't move higher, and this isn't a great buying opportunity, but the odds don't favor it. They also don't favor it because we've had 8% inflation. And if you look at 6% inflation, what you see is that since 1900, before this chart, 50 years before this chart, every time we've seen a 6% rate of inflation, we've had a bank robber and we've had a secular bear market. There was one exception, and that was when inflation got up to 9% in 1951. But in that situation, it truly was transitory. It was the beginning of the cycle in 1949. And and also the market did not respond with a 20% decline, so it didn't respond to that inflation, not like it's responding to this inflation. So let's talk a little bit about recessions, because there's a lot of mistalk about recessions. A recession is defined by the National Bureau of Economic Research, who are the official arbitrators. They're the ones who decide what a recession is, and their definition is a significant decline in economic activity that is spread across the economy and lasts for more than a few months. It is not 2 consecutive quarters of declining GDP. If it was, then the 1920 recession, which lasted for 2 months, wouldn't be called a recession. Also, we find that the National Bureau of Economic Research identifies recessions well after the fact and using the benefit of hindsight, usually a year and a half and so forth after the recession has taken place. So they're telling us what's happened. That may be close enough for government work, but it's not close enough for Pring Turner portfolio management. So we came up with an indicator that helps identify when a recession starts. And that's our Pring Turner leading economic indicator. It's composed of comprises six sectors of the economy, including housing, real retail sales, the stock market, and a measure of the labor market as well, a leading measure. So these are all forward-looking indicators that help tell us what's coming down on the road. Just like we're on a train, the engine is the first one to get to the station, and the caboose is the one at the end. So the leading indicators are kind of like the engine and the train. The red highlights represent recessions, and the vertical lines intersect with the start of a recession. So you can see that in each of these situations, the indicator comes down ahead of the beginning of the recession, ahead of the beginning of the red highlight period. Each cycle is different, and the deterioration required to get to a recession is very different from cycle to cycle. So that's why we use the recession caller, which is really a momentum indicator derived from the Pring Turner leading economic indicator. And when it crosses this red line down here, just below the zero, we call that the recession line. That's when it signals a recession. And if you see these vertical lines, you see they all pretty well line up with the period when the indicator crosses below that red line. Is it perfect? Absolutely not. Just take a look at 1957. The indicator went bearish just here, and it wasn't until several months later that we got to a recession. Whereas in 1960, the indicator was a little bit late in signaling a recession. But by and large, all the way through, when you reach the recession line, you crash and come through it, it's a pretty good high probability that a recession is underway. No guarantees, but a high probability. And that's all we can work with in portfolio management and so forth, is the probabilities, and as Joe was mentioning, the managing of risk. So where is the indicator right now? Well, back in February when we had a webinar, it was just starting to turn over. And it seemed to us at the time that the next recession was going to be quite some time into the future. Since then, it's begun to accelerate on the downside. And with an estimated August number, it's a little bit below the equilibrium line, but above the recession line. I'm not going to argue whether it's a point here or a point there. The point is that it's moving down quite rapidly. And if it continues on that course, it will signal a recession sometime towards the end of this year or maybe the beginning of next year. On the other hand, it could turn around. We don't know, but it seems unlikely since the Fed is determined to raise rates here, 50 or 75 basis points this month, and then smaller hikes as we go on. And this is intended to curb demand. So that should ensure that this indicator continues to move on lower. So let's talk about the stock market and its relationship to recessions. Well, as Joe was telling us, the stock market leads the economy, and recessions are a kind of a coincident indicator of the economy. So before a recession begins, the stock market looks ahead, says we're going to have a slowdown or a recession. We better sell. Oh, once again, I should point out the red highlights represent recessions. So the market usually drops in anticipation of a recession. And you can see that it happens at every cycle with these red arrows. Some red arrows are longer than others because the lead times are longer in different cycles, because no two cycles are ever exactly the same. But you can see there is a definite relationship between the stock market peaking out and the beginning of the recession. Now, the other thing is when a recession starts, that's when you should expect to see the low in the stock prices. But sometimes it's a long way through a recession, because this is a long and deep recession lasting in 1974, about a year or so. So this arrow here kind of demonstrates the lead time between the beginning of the recession and when the stock market made its low. And once again, we can put in more arrows here, which show you again that the recession, the stock market low is put in during recession. Now, the good news is that the stock market, just as it had discounted and anticipated a recession, also anticipates recovery. That's how you can get a rising stock market with red on it. That means the stock market's rising, even though there's a recession, and it's looking forward to the next recovery. So that gives us an opportunity to say to ourselves, what kind of an indicator should we have that can help us identify when that stock market's turned? Well, remember that the stock market turns ahead is a leading indicator. It turns ahead of a coincident indicator, which is the recession. So if we take a measure or a ratio between the stock market and the, say, commodity prices, which are more of a coincident indicator, we get some very useful buy signals for the stock market. And that's one of the things we're watching. So we express this ratio in this chart here, the ratio between stocks, a leading indicator, commodities, a coincident indicator, in a momentum format, which gives it like kind of a cyclicality, kind of reflecting the kind of curves that Joe was showing us in his analysis. So the inflection point seems to arrive when the indicator goes below zero, indicating that stocks have been underperforming commodities, then crosses above its moving average, indicating that stocks are now beginning to start to outperform commodities. At that point in the cycle, it's usually pretty bullish for stocks. And you can see that was the case here in that particular cycle, but I can put in another 11 arrows demonstrating exactly the same thing. There was only one failed signal, and that was in 2001. But by and large, when this indicator turns, it puts the odds in our favor of a new bull market in stocks having already got underway. I should point out, it is already underway. It doesn't hit it at the exact bottom, but it does give us a buy signal well before the top of the bull market. So it's one of the things that we look at to try and determine when the stock market's reversed. Well, right now, the indicator is in an overstretched level on the downside. And that doesn't mean to say that it's bullish. It's not, because it's still declining. But if it's overstretched on the downside, the chances are that it's going to turn relatively soon. So that's something we're going to keep our eye on. Finally, I'd like to say a few words about the relationship between government bond yields and recession. So this is a 5-year government bond yield. Once again, the red highlights represent recessions. And the point is that since the 1950s, rates have almost always declined during recession. And you can see that's the case in all these recessions here. Sometimes, though, there's just a little bit more juice left in on the upside. And in these cases here, where inflation was extremely stubborn in the 1970s and 1980, and there was a little bit more on the upside for the yields to go. But by the end of the recession, the yields were much lower than when they began the recession. So just to summarize what I've been saying, the stock market is greatly influenced by the economy. This is exacerbated when the rate of inflation is high. The Pring Turner recession indicator, recession caller, helps us with the timing. It's not perfect, but it's pretty consistent. And stocks drop in anticipation of business contractions, but bottom during them. And with that, I'd like to turn it over to Jim, who's going to tell us what a difficult year we've had so far.
I thought you and Joe did a great job of explaining that already, but I'll try to pile on here if I can. Yeah, it's definitely been a crazy year for the markets. And I'd like to thank you, Martin, for introducing here, and thank everyone for joining us for our fall webinar here. It's definitely, I'm glad that the power hasn't turned out yet. So hopefully we can make it through here before we have a blackout here in California. But yeah, it's been a crazy year, and I'm going to go over a couple of passive investment benchmarks to kind of give us an idea of what it's been. And going back, this chart should look familiar. It was Martin's last chart, but I think it's the most important chart to explain what's been going on this year for investment assets, because it is a chart of interest rates. And interest rates, the best way to think about interest rates they are like gravity for asset prices. So when you have very high interest rates, it's higher gravity and it's going to push down asset prices, and vice versa. If you have very low interest rates, that's like going to the moon, where you can just float and asset prices continue to trend higher and higher. And if you notice down here at the bottom right-hand corner of this chart, you had a dramatic drop in interest rates from COVID, where the Fed was looking to stimulate and basically bringing interest rates down to nothing. And now you've seen a giant, it almost looks like a rocket ship blasting off up from those lows higher and higher. So that's having a dramatic effect on asset prices. And so let's go and take a look and see what's happened so far this year. So one asset class that gets hurt by higher interest rates, or the movement of interest rates, would be stocks. And this table here shows the performance for the S&P 500 through August. That's 167 trading days through the year. And it's on pace for the 5th worst year since 1928 to begin. And these stocks are the 500 largest companies domiciled in the United States by the size and the value of their business. So these are big companies that are down. This index is down 17%. And actually, in reality, I'd say there's a lot more carnage underneath the surface. That's just for this index. But if you look at smaller companies, or any company that was related to cryptocurrencies, or any company, any of these meme stocks like Bed Bath and Beyond and AMC and all these stocks that were just having ridiculous price moves on a day-to-day, you've really seen those stocks down dramatically more. Some of them down 60, 70, 80% or more so far this year. So Tom's going to go into more detail on our strategy, and it's a case in point on why we look to avoid those types of investments when we're making investment decisions. The second point I'd like to make on this table is, if you look at the middle table there, it shows what the price return was for the index in prior instances after that terrible start to the year. And as you can see, give you a little bit of hope, is I see about equal amounts of green and red. So it's not just a waterfall decline back down, although there were a couple instances where you did see more downside, and that was in 2008 when we had the global financial crisis, and also in 1931 in the Depression. So that gets back to Martin's earlier point that the economy does have an important effect on stock prices. And hopefully it doesn't, it's very hard to predict that type of collapse or downturn. We don't see, there have been some excesses built up, but very unlikely that we're going to have another housing crisis or global financial crisis or depression at this point, but we're going to continue to monitor that. So that's been the year for the passive investor in stocks. And so let's take a look and see how bonds have done as well. Well, bonds are having their worst year since 65. And it's not the year 1965, it's the year 1865. And that happened to be the year the US Civil War ended. And I think Joe made his first stock investment in that year, if I remember correctly. He was telling me about that. But it's been, once again, bond prices have been hurt dramatically. And this is something we've been warning about for several years, actually, and why we've had very little exposure to bonds, because typically bonds are deemed to be less risky than stocks. But when you had interest rates at such low levels, there really wasn't a lot of upside opportunity, and there was lots of risk if interest rates rose, which has happened. So this combination has led to what we like to call a 1-2 gut punch for investors, and especially conservative investors. And this is looking at the portfolio returns for a investment portfolio that would be 60% invested in stocks and 40% invested in bonds. And throughout history, that's been known to be a relatively conservative, passive investment portfolio for someone that's looking to continue to stay up with inflation, earn some solid returns, but not take unruly risk. And as you can see here, this chart goes all the way back to 1976, which happens to be the year before Pring Turner was founded in 1977 there, that first down year. And so as you can see, this has been the most difficult year to invest for conservative investors over the last 45 years at least, and it could be longer. So it's been a very difficult year, but the good news is we've used other tactics. We're not passive investors. We don't just invest in a 60-40 portfolio. We don't just invest in the S&P 500 and hold those investments through different parts of the cycle. We do make all season adjustments to that. And Tom's going to go into some of the other tactics as well that have allowed us to sidestep a bit of this decline and make it relatively more smooth journey for all of you.
Okay, thanks, Jim and Martin and Joe, Pamela and Katie. Appreciate it. And great job showing the backdrop that we're dealing with right now. And some of you may be thinking, gee, this sounds a little depressing right now. There's hasn't been a lot of good news. We've been talking about stagflation, inflation, bear markets, burglars, bank robbers, and then Jim going through the year-to-date returns in the major asset classes. I just want to remind folks that is not your portfolio. You are doing much, much better than, say, those indexes are showing, and certainly the 60-40 portfolio might be what average passive investors are doing. These types of years really remind me why we embrace the proactive conservative strategy that we have. Joe and Martin began decades ago and crafting a conservative investment plan. We've tweaked it, and along the way, we think we've made it better and better. But you know, in the midst of one of the worst years for stocks and bonds combined, you're doing well. And sure, there's no fun. Bear markets are not fun. Bull markets are a lot more fun. But you survived. That was kind of the title of our last newsletter, Survivor. In one of those difficult periods, you know, we're pleased to say that you're in good shape. And I can explain how we are. Part of it is the business cycle research that we do. And Martin had developed barometers for the different markets many, many years ago. And he also has been tweaking them over time. And these barometers help tell us where we are in the business cycle so that we can make adjustments. So when we started the year, things were a little sunnier. We were in growth mode. But as things changed and data came in, we got more cautious. Using the weather analogy, went from clear skies to maybe some cloudy, slight rainfall out there, little more cautious attitude. And more recently, you may have noticed we've been taking some more profits in portfolios, going into more of a protect mode as we get even more defensive for you to protect your portfolios from any further declines. And we started this whole process, not just this year, but really last year, where we had taken some profits in portfolios, sold some stocks. Any stocks that we added, we were looking at recession-resistant companies like utilities or staples. Even this year, we were adding to treasury notes in the portfolio. Now that interest rates have gone up to where you can actually get a reasonable return in a treasury note, for the first time in many years, we started adding to your bond ladder and adding extra income to the portfolio. That also helps stabilize the portfolio through challenging times. So it's been a gradual process, but over the last really 12 to 18 months, we've made steps to get more defensive. We think that's been one reason why we've been able to temper the declines that so many others are probably feeling right now. We do have extra cash on the sidelines, and I can guarantee you at some point that little needle on the chart is going to move back towards more towards a growth mode again. And when it does, we'll have that extra cash to make investments in some of the bargains that are starting to show up. So this is business cycle 35. It's getting near its end, but there is a business cycle number 36 that will follow it. And that will take us to a new bull market that we're going to be on the lookout for. So reason number 2 that your portfolio's held up really well this year is our focus on quality companies we believe that are good values, and also ones that pay good dividend income streams. So this is from our February slide. You may remember it, but it was just a study from Value Line that compared high quality stocks with low quality stocks going back the last 16 major stock market corrections back to 1972. And it's pretty clear that the high quality ones go down less, much less than the lower quality ones. So for instance, in the S&P 500, they have high quality companies, but they also have medium quality, low quality, and very low quality companies. We like to just stay in that very high quality zone for you. We think that is an added level of risk protection in case we don't quite get the economic forecast right. At least we'll have what we call a belt and suspenders approach. There's something else holding up your portfolio. There's more than one discipline to help protect you through those down periods, and the quality value income is a really important component. So far this process is working just as expected. High quality stocks are definitely outperforming the rest of the market. So we think adding that extra protection gives you that protection just when you need it the most, when those storm clouds arrive on the scene. And in my final slide here, just want to demonstrate, really it's the Pring Turner mantra. You know, we want to protect portfolios in the bad periods, because if you go down less in the bad periods, it's much easier and quicker to reach new highs. So if the black line and arrow there is a depiction of the stock market, or even a 60-40 portfolio down quite a bit, it's going to take a while for those portfolios to get back even. I mean, if you're down 14% on the year so far, it's going to take a lot longer to get back up to just where you started. Whereas in the Pring Turner portfolios, we're down much less than that. And that means we're going to get to new highs much faster and quicker and easier than the markets, so to speak. Lastly, I'd just like to leave with a quote from a very famous value investor by the name of Shelby Davis. He may not be as well known as Warren Buffett, but he's equally as successful in terms of his skills at investing and money management. And he had a very famous quote where he once said, "You make most of your money in a bear market, you just don't realize it at the time." And I think that just perfectly explains exactly what's going on in this graphic of just doing a good job protecting in the down periods so that you can grow your wealth in the good periods. So we're pleased with performance so far this year. We're going to open up the questions in a little bit, but first I'll just do a quick summary of the entire event here. I get the bat cleanup. Once again, welcome, Katie. She's our new operations manager. You'll be making much contact with Katie from now on, taking care of your needs. Katie's a fantastic person. We're so lucky to have her. We met her just last week when she came out to California to visit us along with her husband, and they're just wonderful, wonderful people, and I'm sure you'll agree. So she's making Pring Turner even better. Secondly, on the financial and retirement planning tools, we're so proud of our own Pamela here, who not only was working hard in operations the last 8 years, she was also studying to get that certified financial planner designation, which she did get here in the last year. So she's moving along in her career, and we're so proud of her. And you know, we know she'll do a great job in the financial and retirement planning side for us. Okay, so you've had a good 45 minutes of financial market update. We are later in the business cycle. You're doing just fine in a very challenging environment. We may not be quite ready to get back on offense for you, but you know, we're getting closer. We're paying attention, and you'll know as we get more active. You know, when the evidence changes for the better, we will certainly take steps to become more towards the growth side for you. So again, that just explains our proactive style. We think it's pretty unique, built around business cycle movements and having that extra layer of protection with the quality, value, and income components to your portfolio. All right, well, thank you all. And we really believe that, over these last 45 years, you are the reason for our success, and we appreciate you all. And we'd love to hear any questions you may have. And Pamela will probably be the one moderating. She's probably checking the chat box and Q&A section right now. So if you had any questions, pop them in that bottom part of your screen, and we'll be glad to do our best to answer them for you.
Absolutely. Thank you, Tom. Thank you, everyone. And thanks to everyone who's stayed on the conversation this long. We'd love for you to pop in as many questions as you'd like for us at this time. If you look at the bottom of your screen, you'll see a little Q&A icon. Feel free to pop in any questions there for us. I do have a few questions here that what I'm going to do is just open-endedly ask the question. The team's just simply going to answer popcorn style, and we'll go from there. So the very first question I have is, how does this environment compare to any others you've managed through? Are there any others that you'd find similar?
Well, it's interesting when Martin popped up that last chart that showed inflation adjusted burglars and bank robbers. I counted 13 since we started back in the late 60s. So we have bear markets. They're a regular occurrence, and it's one of the things that we prepare for and that we use to our advantage to protect portfolios. But I would say probably the greatest or the closest connection would probably be the 1973-74 bear market, which had a lot of inflation with it. And in this case, I think the Fed, all I've seen on Bloomberg today is how every federal government or every Federal Reserve chief has come out and said, we're going to stay the course until we get inflation under control. So that's the pain part. So that's why I would say 1973-74.
Awesome. Thank you, Joe. And
Ben says Joe was around all the way back to the Civil War. I think that's great to have his experience and wisdom on our side. Just kidding, Joe.
Well, I was going to mention the panic of 1907, but probably a lot of people wouldn't recall that one.
Awesome. Well, thank you, Joe. We do have a quick question asking about Katie's phone number, which I love. I can't wait for all of you to get to know her more. Truly, she's just a delight and such a wonderful addition to our team. So you can reach Katie through our direct main office line. It actually rings right to her phone. So the 925-287-8527. But when we follow up, we'll follow up with the recording of the meeting and so forth. We'll make sure to include that information so you can have her direct email and contact and store that in your records there. The next question I have is, how often as a team do you discuss changing market environments, and how quickly do you respond to those?
Jim, why don't you?
You want me to answer that one? I mean, That's every day. That's our job. We're always, that's what we're constantly doing. And as you can tell, Joe and Martin especially just completely obsessed with trying to figure that out. And always trying to tweak our indicators or models or get some sort of edge on things. So that's our job. That's what we're constantly doing. And there's a difference between actually making an investment action and thinking about making decisions. And so we try not to make too many actions, because actually if you trade too often or get in or out all the way, that there's lots of studies that show that that's not necessarily the best way to go, especially for your long-term retirement type assets. So we're constantly thinking about those and making decisions when the risks and rewards change. And so we're just trying to put the odds in our favor a little bit. And anytime we feel like we have that, then we'll make a little bit of an investment. And it's a constant process there.
I would add just that Martin's barometer models change at the end of each month, so we review those then. And we also do what we call an intermediate model. We call it the fuel tank, that gets updated each week. It's more of a shorter term outlook. So yes, it's a full-time job, and we love it. Next question.
Good answers. Okay, the next great question. Are there any special pivots, perhaps actions, we should consider if retirement is within the next 5 years?
Okay, I'll take the first shot at that one. I think it's a great question. Actually, sure, as you approach retirement, you have to really think carefully about your retirement, whether it's a 401k or a pension or profit sharing plan, and how it's invested. But rather than time until retirement, it really is just about where are we in the business cycle? You know, is it a point like right now where we're in more of a cautious stance? Whether you're 1 year away, 5 years away, or 10 years away, we would suggest taking a little bit more cautious approach for the time being. And then when the business cycle turns to our favor, and which is most of the time, thankfully, then we would get more, suggest more growth oriented. And that doesn't matter what age you are or how close you are to retirement. It's really more about where are we in the business cycle that makes sense to us.
Yeah, and I'll add to that. So Tom, that was an amazing investment, answer and approach. From a general perspective, from a financial planning type perspective, there could be other things that may be beneficial if you're planning for retirement within the next 5 or 10 years. However, I'm going to caution to say anything specific right now, because those steps are very much unique to your situation. So if you do have those unique questions or specific questions that you want to go over, perhaps is there something that I should consider, not just from an investment perspective, but whether it's insurance coverage or mortgage repayment, the rate of it and so forth. Feel free to just shoot us over an email or call, and we'd be happy to kind of walk through in greater detail if there's any other action steps that might complement your financial journey. Okay, next question. Do you expect the Fed to raise interest rates too aggressively? So for example, overcorrect as they seem to do in these circumstances, and would that force a recession?
But I think Joe laid out the fact that the Fed a lot of times don't really know what they're doing. And a great example of that was when they started raising rates in February of this year, and they were expecting to raise them later than that, but the markets had already moved ahead of them. And so why should we expect that they're going to get it right at the top here when they're raising rates? I don't know why we would expect that. And the other thing is they're saying that they're going to stay the course, but of course talk is cheap. When there's blood on the streets, there's a totally different environment. So I expect them to raise rates too much and cause more of a recession than we would have otherwise had. And that, of course, is not all bearish, because it means there's a great buying opportunity at the end of it. And if our data changes in the meantime, we'll go with that.
Great. Any other adds to that?
No, I just reiterate what Martin said is the Fed has put themselves in such a box and put themselves so far behind the curve that in order to regain credibility, they have to keep raising rates because they've said our target is 2%. And that means you have to raise rates a lot, from today to get inflation down to 2%. But as Martin says, there's going to be a day of reckoning down there. It's one thing, talk's cheap when you have unemployment, at 3.5% as in today, but part of the price of bringing inflation down is going to be a recession, and unemployment's going to go up. So we'll see, how much staying power, how much fortitude the Federal Reserve has when they're faced with hard, harsh facts and a lot of political pressure to ease up.
Joe also made the point that they're going to continue raising rates until something breaks. And I think that's a really fundamentally important point to bear in mind. Because when something breaks, like the stock market going down or bankruptcies expanding or debt defaults taking place, that concentrates the mind of the Fed. But unfortunately, there's a lag between when they can act to put that thing right and the fact that it's falling off a cliff.
Thank you. Those are awesome answers. The next question is, how long does it take for you to do a financial plan? I guess I'll answer that one. And this may be an annoying answer, but it really does depend. It's very unique to your circumstances, how complex your situation is, how timely we're able to obtain information and input it into Money Guide and coordinate, a review with you. So it very much depends. I don't even want to put a direct timeline on that, but generally speaking, it is a few weeks process, especially if this is the first time you're ever doing a plan. It's very new to begin collecting all of this data. That's very helpful and important, but it can take some time to collect information. So from our perspective, though, there's zero rush from our side. We work with you on your timeline when it's convenient, and we're here to help you along the way. So hopefully that general answer is helpful.
I will say that once we have that data in the software package, as we make changes years down the road, next year, the following year, or as you actually hit retirement, for instance, and your circumstances change, all that data is already in the system. There's a few little updates, and we can make updated plans for you, quite quickly. It's really, I'm impressed with it myself. So
awesome. Yeah.
Talk to Pamela. Yeah.
That's a very, very good ad. Thank you, Tom, for adding that. The next, thankfully, this is hopefully a simple question, maybe for Katie or Jim. How do I get started on the Pring Turner vaults?
I'll answer that question for you. So if and when you want to share a document, we can get you set up ahead of time, but we can use it when at that time you want to share a document. So you have your everything, your password for the vault is all fresh in your mind. You give us a quick call, and it doesn't take long for me to set it up on my side. You'll get an invite from that Pring Turner vault, and it'll walk you through the setup. I can even stay on the phone with you and walk you through it as we're talking on the phone. So it is just literally a quick phone call away should you want to share those documents. Pamela will be using the vault to share documents as well with financial planning. So any sensitive information, it's a great tool, but we are just a phone call away for that setup. So don't hesitate should you need to share sensitive information with us.
And then Katie, as a follow-up, you talked about the security and not having your computer be compromised. I forget, is there a team or someone at Schwab, if you do feel like you've been compromised, that can help?
Yes.
You out? Yeah.
Yes, there is a Schwab identity theft team. So that if one of you called me and said, hey, I think my computer's been hacked, I'm immediately going to give you a phone number for the Schwab identity theft team. And basically they're going to walk you through a process to make sure that first and foremost, the Schwab accounts are protected. They can put some extra security procedures in place. And they're really not so much worried about, they have some really great security procedures already in place, but they want to make sure that you're doing what you need to do on your side. And that team is great and they'll walk you right through it. So if you don't know the number, and you're looking for it, don't hesitate to call me. I have it, I'll have it there for you and ready to go. And they'll take care of things on their side. Let us know, we still want to know as well. Just so we can just put a note in our system that if we see anything weird or suspicious, we can address it as well. We've had great security here at Pring Turner from after I asked about some of the history of that, and everybody's doing such a great job here. And a lot of that is because we know our clients so well, and we want to continue that going forward. So just hopefully that answers that question there. There's things in place and we'll walk you through it should that time arise.
Awesome. Perfect. Thank you, Katie. And this last one isn't necessarily a question. I just think it's really sweet, so I'm going to share it. It's for Katie, actually. Just wanted to say, wow, I'm impressed by all of Katie's athletic endeavors. Welcome, welcome. Look forward to getting to know you.
Well, that was very nice. Thank you very much.
Yeah, well, there's a couple of things. I don't know if we mentioned it, but she actually resides in Whitefish, Montana. So she's an hour ahead, but she's on our time. So she's definitely has great access to the outdoors there. And the other thing too is she's coming from a firm that was significantly larger, doing the same job. And so she's going to take all of her experience and knowledge from her time there and really improve our operations here. And I think it just goes to show, this is the year where lots of people have been, say, retiring or leaving their job or going somewhere else, and we're actually able to retain and get more talent and stability in that area. And so we think it just speaks largely to the team that we're developing here and all of our clients that we have. So we're really looking forward to the next steps with everyone.
Absolutely. Absolutely. And looks like if anyone else would like to pop in a question, you're welcome to, again, just in that Q&A icon there. We have a final question here. Is there a charge for the Black Diamond service?
Nope.
There is not. There's no charge at all. This is part of the client service we're able to offer you. And again, it's how we share sensitive documents day in, day out, and no charge at all. It's all complimentary part of the client service that we provide. So.
Absolutely. And I will add, it is our preferred method for secure document sharing, but it's also a fantastic place to go where you can see a quick snapshot of your portfolio performance. So it has even greater functionality than just document sharing. So, and just like Katie said, it is entirely complimentary, just as your financial planning offering is. We believe in always pursuing better and improved services for you every year. So this is simply staying true to that commitment. Thank you so much to the Pring Turner team. I love you. You're awesome. And we appreciate our client family so much. We look forward to our next event with you.
Thanks, everyone.
Thank you.
Thank you.